After spiking to a 2.5-month high against the US dollar on July 11th, the Canadian dollar began a streak of 12 consecutive days closing lower. Now, the daily losing streak represented the longest such since 2018. Now, a sizable part of the weakness is understandable, as the Bank of Canada has been quicker to cut rates, having done so twice so far this year than their counterparts at the Federal Reserve. But there's another factor being talked about. Now, historically, the Canadian dollar trades with a strong correlation to the price of oil. This reflects the oil export relationship they have with their neighbor, the United States. Now, in the spring of 2023, that correlation seemed to have completely broken down, as oil had a 4-month rally and the loonie had a corresponding 4-month decline. Now, throughout 2024, however, it seems like the correlation has returned. Since July 11th, crude has had an over 7% pullback, and this seems to be a key factor in weighing on the loonie, and it's almost 2% decline. Now traders will turn their focus to the Fed, who is widely expected to begin their hiking cycle at the September 18th FOMC meeting. Of course, there are major data points coming out between now and then, with labor data on September 2nd, and then PPI and CPI on September 13th and 14th. Now, the CME Group offers 3 different sized currency contracts: the standard, the mini, and the micro. In order to match a trader up with their preferred risk tolerance, we're going to be using the micro in these examples. If a trader believes the Canadian dollar could continue lower from here, they could express that by selling the September micro Canadian dollar futures contract at 0.7234 and target a move to the 2020 lows of 0.6850. Now, stop for this trade could be placed above at 0.7500. This trade can make $384 if the target is reached and risks $266 if you're stopped out of your level. Now, if a trader believes the Canadian dollar could bounce from here, they could buy that September micro Canadian dollar futures contract at 0.7234 and target a move back to the January highs of 0.7600. Now, a stop for this trade could be placed below at 0.6990. This trade could make $366 if the target is reached and risks $244 if you're stopped out of your level.